Markets are now focusing on the upcoming US inflation data, consumer price index and producer price index. The difference between the two, one of them is a leading, the other one is a lagging inflation indicator. And you guessed it right, consumer price index. Consumers are at the very end of the supply chain, therefore it's a lagging inflation indicator, whereas producer price index, the producers are placed at the beginning of the supply chain because they are producing the goods and services, and the producer price index, as well as the CPI, the consumer price index, measures the change of the price of goods and services at the producer and at the consumer level. So if producers get the cost that goes into, the product that goes into production, of course the cost is going to be higher, and as soon as it gets passed down on the supply chain, when it reaches the consumer, the prices will increase. And of course, these releases are importantly shaping the market sentiment around the Fed monetary policy expectations. Traders currently expect up to 50 basis point rate cut by the end of 2025, starting in September or October. The first thing I want to show you is my CPI chart, which I've been administering or following CPI for close to a decade, but I've started 4 or 5 years ago documenting every single CPI I traded. On the chart you can see it dates back to February 2021 and currently is 2025 July. Every single CPI I traded documented on this chart. Now, if you want to get access to this chart to analyze and learn how gold moves against CPI, you can go to my my Telegram, and you can find this chart right. I think it's the second last post. You can download it, and you can get a nice visual correlation about gold and CPI reaction. You can see that the last 8 to 10 months, we can say that inflation has been decreasing more or less on some places. For example, in December 2024, the headline CPI was a little bit higher, but core was unchanged. If you look at the general trend, we can say that inflation has been decreased and it was going down, which was of course bullish for gold. Now we cannot say that it was purely because of the inflation, because correlation is not causality. This is a very important rule that you understand. We had geopolitical conflicts, we had wars, we had tariff misery, which put extreme anxiety in the markets, and of course traders and investors go to gold as a safe haven asset when the shit hits the fan. Today in the economic calendar we have CPI, which is the Consumer Price Index for the United States of America, at 1:30 GMT, 2:30 Central European Time. You can see that the expectation for CPI, if you look at the core level, is a slight increase from 2.8 to 3%, and the headline CPI again slightly higher. Now, we saw that the tariffs started to kick in on 1st of April, 2nd of April, and we haven't had a significant increase in inflation. Everyone, including myself, was expecting a massive spike in inflation because retailers and wholesalers rushed to load up their inventories, but nothing really happened. So we could have some knock-on effect because the tariff induced shopping spree among the retailers and wholesalers. And this could be very well the one I'm talking about, that inflation was going up because of that tariff fears. So now that we understand what is the forecast or the expectation from the economic calendar, we can go down and start the technical analysis. Now, as always, we have two options for CPI. If CPI comes out lower than expected, and if CPI comes out hotter than expected. Don't forget that we have a 75% deposit bonus offered by Forexy, which is a perfect opportunity for you guys to get some extra money before CPI. Now let's talk about lower than expected CPI, which is my favorite bias, because if you look at the trend that gold has been following for the past few weeks, you can see that it's clearly in an upward trajectory. If CPI comes out lower than expected, the price pressures keeps easing and the rate cut odds will increase. Dollar and yields will retreat. That means if we have a lower CPI, anything below 0.4 or 0.3% on the core level, and anything below 2.4 On the headline CPI, you can see that the previous was 2.4, the forecast is 2.6. If anything comes out below 2.4%, you can be 100% sure that gold is going to revisit 3,400 or even higher. So that is my base case scenario. I'm expecting CPI to come out a little bit lower than expected, but if it comes out significantly lower than expected, then we're going to see gold prices close to 3,400. Now, I do have a front-running position, which is a buy. You can see that this was opened on the 15th of July at 8 o'clock because it's a one time ahead by MetaTrader clock. So I have a front-running position, and this was sent out for the members in this format. You can see that this is the AlphaFX VIP members channel. You can see that I sent out at 9 minutes past 8 o'clock the full macroeconomic analysis, full scenario analysis with my signal. If you want to become a member to the AlphaFX family, go to alphafx.eu, click on purchase and enjoy one of the memberships. You can join monthly, you can buy a lifetime, or you can buy premium lifetime, which includes 3 hours of mentoring. Of course, the mentoring hours adjusted to the level of discount. I would go for the Pro plan because this has everything you need. Now, going back to the chart, what if CPI doesn't come out lower than expected today? What if it's in line with the expectation and you can see the expectation is higher inflation? Now, in that case, what happens is that CPI comes out hotter than expected, the inflation fear is going to re-escalate, and the Fed will stay on the higher for longer rate scenario. And of course, that's going to increase the real yields, which you can see on this Coifin chart. I highly recommend it for everyone. These are the global yields for the biggest countries in the world. If you look at US, which is the black line, you can't really see it too much, but you have the white one, which is the US long end of the treasury curve. Or the yield curve, you can see that it's close to 5% and the short end is close to 4%. So the yields are going up again, which has a bearish pressure on gold. Now, yields could go up because the risk premium demanded by investors who lend money for the government or to the government are increasing. So risk premiums are increasing, and that's why the yields are increasing as well. Now, this is bearish for gold, and if we have everything in line with the expectation or the forecast of CPI, then this is going to be bearish for gold. So if CPI comes out hotter than expected, we can see gold prices get hammered down below 3,300. So right now, price is moving sideways. And if CPI comes out hotter than expected, you can be 100% sure that gold will revisit or deep dive below 3,300. But if CPI comes out lower than expected, gold will skyrocket above 3,400. So right now, what I can see on the chart is price is moving sideways. So we have a decision zone. And most likely before CPI, price will continue to move sideways, and we really need to see some significantly higher or lower prices on consumer price index in order for price to move out from this consolidation. If this doesn't help, then we have PPI tomorrow, which of course we are going to live trade as well. So you can see that tomorrow we have the PPI and the forecast for PPI again higher than expected. So this could be an explanation why the yields are started to climb up again, especially the 30-year US government bond yield is close to 5%. The short end, which is the 2-year treasury yield, is close to 4%. Again, this is going to put some bearish pressure before the CPI. My expectation is in line with the forecast or slightly lower. So I mentioned I'm on the bullish side. My bias is cautiously bullish for gold today. But of course, we have other assets as well, for example, the US dollar and indices. Now, if you want to get the full analysis, to get access to my entries and my trades and a full macroeconomic analysis, you have to go to alphafx.eu and you get access for everything. You will get the briefing well before the market opens. And of course, I'm going to live trade with the members the consumer price index data release today at 1:30 GMT. And let's talk about Bitcoin as well. You can see that the yields on the government bonds in the US are started to climb up, and that is quite bearish for Bitcoin. But if you compare Bitcoin with gold, which many people say that Bitcoin is the new gold, you can see immediately that gold hasn't been going down even though yields are going up. So you can see that Bitcoin already started to get hammered down because the yields on the US government bonds are going up. You can see that this nice drop from 122,000 all the way down to 116,000, which is a $6,000 dump. And if you look at gold, gold is going up. And not because the anxiety in the markets, it perfectly depicts that Bitcoin is still an extremely volatile asset, and it reacts more significantly and way bigger to these minor moves in the fixed income market. When the yield started to go up, you can see how significant Bitcoin started to bleed out. That's because Bitcoin doesn't bear any interest. It's similar to gold, yes, but when you look at the two assets, you cannot really compare them. And to be honest, Bitcoin is nowhere near to the market cap. Of course, we can do a similar analysis on Bitcoin as well. For example, if lower CPI comes out today, then it's going to be most likely bullish for Bitcoin. But if CPI comes out hotter than expected, then it's going to be extremely bearish for Bitcoin. Don't forget that we have a 75% deposit bonus offered by Forex, which is a perfect opportunity for you guys to get some extra money before CPI.